Welcome to this explainer. Today, we're throwing on our senior equity research analyst hats to run a rigorous, purely data-driven stress test on the London Stock Exchange Group, better known as LSEG. We're not just glancing at surface-level metrics here. We're taking their latest financial filings and running them straight through the legendary frameworks of Warren Buffett, Benjamin Graham, Philip Fisher, and Peter Lynch to find out what this company is really made of.
Here is our analytical gauntlet for today. First, we'll define the asset itself. Then we apply Buffett's moat test, Graham's strict margin of safety criteria, Fisher's qualitative growth check, and Lynch's growth at a reasonable price framework. Finally, we'll triangulate its intrinsic value with some hard valuation cross-checks. Let's get into it.
Section 1. The asset, LSEG explained.
Before we start applying these heavy-hitting frameworks, we've got to get clear on what LSG actually is today. If you're still picturing a traditional trading floor with folks shouting over each other, you're missing the real story. This quote hits the nail on the head. LSG is a systemic financial infrastructure utility that has pivoted to a global data powerhouse. Thanks to their Refinitiv acquisition, roughly 77% of their revenue now comes from recurring subscriptions and analytics.
And you can literally see the operational leverage playing out in their first half 2025 results. They're expanding EBITDA margins by 150 basis points to an incredible 49.5%, all while growing adjusted earnings per share by over 20%. This is a business that's scaling with serious hyper-efficiency.
Moving to Section 2, Warren Buffett's test for moat and quality.
We start by asking if LSEG is a great business at a fair price, based on Buffett's strict criteria. Let's run through the scorecard. Buffett wants gross margins over 40%, while LSEG's EBITDA margins are breaking 50%. That's a pass. Do they have a durable monopolistic moat? Consider this. Their LSEG swap clear division clears around 90% of the global interest rate swap market. That is a $1,600 trillion notional value moat. Absolutely a pass. And management? They're acting exactly like owners, returning massive amounts of capital and passing this scorecard with flying colors.
The engine behind all that quality is sheer cash generation. Looking at the first half of 2025, LSEG delivered a 43.6% growth in equity-free cash flow. Because their capital intensity is dropping, they can convert surging operating cash flow straight into a massive £2.4 billion of equity-free cash flow for the full 2025 year alone.
And that immense cash generation leads us directly to this staggering figure, £5.1 billion. With all that free cash flow, management is playing the role of a cannibal compounder. They're executing £2.1 billion in buybacks in 2025, with another $3 billion planned by February 2027. That's exactly the kind of relentless capital allocation Buffett absolutely loves.
So the quality is undeniably there. But as we know, quality isn't everything if the price is wrong. We've got to shift our focus strictly to the margin of safety to see if this asset is priced defensively enough for the father of value investing, Benjamin Graham.
Section 3. Graham's margin of safety.
Benjamin Graham is hunting for deep value opportunities, strict defensive criteria, and assets priced for the absolute worst-case scenario. For LSG, well, it's a bit of a mixed bag. Their total income of around £10.5 billion easily satisfies his defensive scale requirements, and their earnings growth is spectacular. But Graham is famously stingy, right? He wants a trailing PE under 15, and LSG is trading at 19.9. Also, because of its massive, highly valuable but intangible data assets, it completely fails the strict price-to-book multiplier test. It's just not your traditional Graham net-net deep value bargain.
But look, just because it fails a 1930s deep value test doesn't mean it lacks protection. The real takeaway here is that its modern equivalent of a margin of safety is found in its sheer scale, its monopolistic clearing moat, and a highly defensive 7.0% free cash flow yield for 2025. That yield provides an incredible floor for the stock, completely independent of whatever macroeconomic turbulence might hit.
Section 4. Fisher's qualitative growth check. Now we apply Philip Fisher's framework. He cares about what the numbers don't always immediately show: durable internal growth and massive market potential without diluting shareholders. LSEG really delivers here. 73% of their revenue comes from high-quality recurring subscriptions. We're talking about data feeds and analytics terminals that global banks literally cannot live without. This incredibly sticky revenue perfectly aligns with Fisher's demand for high-visibility market potential.
And how are they doing on R&D and innovation? Brilliantly. LSEG checks Fisher's box through a landmark 10-year strategic partnership with Microsoft. They're expanding distribution and content capabilities, pivoting to become an AI-ready, multi-cloud data layer for the entire financial ecosystem. They aren't just maintaining a legacy product, they're aggressively reinventing it for the future.
Section 5. Lynch's GARP Framework.
Stepping into the shoes of the legendary Peter Lynch, we want to know if LSEG has 10-bagger potential at a reasonable price. Lynch avoids boring slow growers, but he's also pretty wary of risky hypergrowth. LSEG hits the sweet spot perfectly with a 23.9% adjusted EPS growth trajectory over the last 12 months. In Lynch's system, this makes LSEG a fast-growing stalwart. It's a massive, stable company growing earnings aggressively because its capital expenditure intensity is dropping down to just 9.5%. They are literally doing more with less.
Which brings us to what is arguably the single most crucial metric in this entire explainer: 0.83. This is LSCG's PEG ratio, price to earnings divided by growth. You take their 19.9 PE ratio and divide it by that 23.9% EPS growth. Peter Lynch has a non-negotiable rule: the PEG ratio must be under 1.0. At 0.83, LSCG strictly passes the Lynch GARP test. You are getting stellar growth for a very reasonable price.
Section 6. Valuation and cross-checks.
Okay, we've passed Buffett, Fisher, and Lynch and found modern protection for Graham. Let's triangulate its intrinsic value against the broader market. There is a massive valuation disconnect happening right now. The market is pricing LSEG at an enterprise value to EBITDA multiple of just 11.3 times. Compare that to direct peers like CME trading around 16 times or S&P Global at 18 times. LSEG boasts software-like recurring margins, yet the market is pricing it like a distressed utility. They're essentially assigning zero value to their Microsoft AI integration upside, all while offering investors a very comfortable 6.1% shareholder yield just to wait.
Which leaves us with this final provocative thought to take away from this explainer. With your downside heavily protected by a massive free cash flow yield and billions in buybacks, the ultimate question is this: as their Microsoft AI innovations automate manual workflows and potentially push EBITDA margins structurally past that 53% ceiling, will the broader market finally wake up and re-rate this utility into a premium software multiple? For the focused learner, LSEG's data-driven transformation is absolutely a masterclass worth watching very closely.